everyone, and welcome to another edition of ChartYourTrade.com's free webinar series. I'm your host, Michael Lamott. I am the founder of ChartYourTrade.com, and today we'll be discussing Advanced Entry and Exit Points Part 2. With us again is keynote speaker Adam Sarhan. Adam is the founder and CEO of Sarhan Capital, which is parent to FindLeadingStocks.com. Without further ado, here's Adam.
Part 2, Advanced Entry and Exit Signals. For those of you that don't know or are new to me, definitely check out FindLeadingStocks.com. On the strategy page, it'll go through my investment system, DAMP. I created this, basically reverse engineered it from years and years and years of not getting the results I wanted, and I started from scratch. You know, Einstein's definition of insanity is doing the same thing, expecting different results. And I'm well versed in all the normal teachings out there, and I said, okay, well, this isn't working for me. Nothing wrong with the teachings, it's just it's not working for me, so I've got to find something that works for me. And the A, which we're discussing basically this webinar and the prior webinar with advanced entry and exit signals, is just that. It's just you need to get in early. Buying the breakouts just weren't working for me, so I need to find a better way. And the idea, the concept that I want to drive home that really clicked when it went through my head was, okay, there's a better way to do this. And the whole idea of an advanced entry, and what's I've asked all the time, what's the definition? People want that rule. You know, they want to be told what to do, which is perfectly normal and fine. But the idea, the definition, in my mind at least, it's that you get in early and not reckless. You just get in early. You're buying closer to support as far as the entry. And the whole idea is, in simplest terms, it lowers your risk. So it's a lower risk entry point. And everything's risk versus reward in this business. The exits, as far as advanced exits, which we'll cover also briefly here, it's either two types of exits. Either you're taking a gain or you're taking a loss. Earlier in the last webinar, we talked about defining your time frame. It's very, very important for you to define your time frame. Are you a trader? Are you looking to get in, get out? Are you speculating? Or are you an investor? You know, I have Warren Buffett types investors. I have clients that are just buy and hold, and then they're buying undervalued stocks, and they'll just hold it for years, decades, if not longer. And that's perfectly fine. I'm not here to say one way's right or one way's wrong. Everybody's just got to find what works for them. And once you define your time frame, are you holding this for a few days, a few weeks, a few months? Are you an investor? Are you a trader? It'll really help you define when to get in and when to get out and give you better results. So the last webinar we talked about Stan Weinstein's great analogy. He's got 4 stages for the market, stage 1, 2, 3, and 4, which basically, you know, a lot of questions on that. Definitely recommend reading his book, How to Profit in Bull and Bear Markets. It's available on Amazon. I have no affiliation with the guy. He's just a genius in his ability to simplify a complex subject. But after the last webinar, I had a lot of emails, and they were asking, okay, well, what exactly does that mean? So I simplified it even further, and what if, you know, internally, what we talk about are there's 3 states. Forget the word stage, because you can talk about bases in stage 1, the late stage base is stage 5, and then the stage of the market, you know, the 1, 2, 3, 4 with Weinstein. Everybody uses the word stage, and they use it differently, so it's a lot of confusion. Keep it simple. There's only 3 things the market can do. I don't care what stock it is, what market you're trading. You know, I was quoted today in the journal talking about coffee markets. Ticker symbol is JO for those of you that are following with the ETF. Exploded higher. And what basically happened? It's just a matter of, okay, there's 3 states. You were in a sideways consolidation area, and then you hit an uptrend. It broke out, and boom, it just took off. It soared. And the only other possible scenario is that you have a downward trend. You know, gold, for example, is in a bear market. The S&P was in a bear market in all of 08, or the vast majority of 08. So you have these states. So if you think of, you know, you're in a happy state or you're in a sad state or however you want to use the word state, but in my mind it's okay. There's uptrend, you're going sideways, you're going down. That's it. There's only 3 possible scenarios. So I adjust my strategy based on the market state. Now your time frame determines your state. Are you in a longer term frame, or are you looking at a 30-minute chart or a 1-minute chart or whatever the case may be? But for the most part, where we thrive is, again, capturing the bulk of the move. It's the weekly time frame and the daily. But the typical hold periods on winning stocks is weeks and months, sometimes longer. And the losing ones, obviously, you're out whenever you get stopped out. But if you're able to understand that you're in an upward trend, okay, great. So as we've discussed earlier in the first half of the webinar with the market overview, we're in an uptrend in the market, and we know pullbacks they're inevitable. They're going to happen. At the end of tonight, you're going to go to bed if you're a normal human being. If you're not going to go to bed tonight, you're going to go to bed tomorrow. If not tomorrow, you're going to go to bed the next day. It's the same thing with the market. You know, the stocks, the Philly Semiconductor Index was up 11 days in a row, I believe it was, as of today. So you're not going to just go straight up. You're going to pull back. So you have periods where the states change, and you can have a downward state within an upward trend, But understand that pullbacks are normal in uptrends, just like in a downtrend, you're going to have relief rallies or sucker rallies or dead cat bounces, whatever you want to call them. But it's normal and it's healthy as long as you're within that broader uptrend. And then you're going to have sideways periods within that uptrend, and you're going to have sideways periods when markets top and bottom. So in October of 07 or in March of 2000, you had a big sideways period. It was a top. And notice we put out a report. If you're interested, join the free newsletter that went out for free to everybody that just says, listen, back, I think it was 2 weeks ago, we made a comparison between 1987 and February of 2014 and said it's not the same. Here are similarities, here are the facts, and here are the differences. And in general, a lot of people are emailing and reporters are asking, what is, are we topping out? Is it that's it? Every time the market pulls back, is this it? Are we over? Are we done? And the answer is, I've studied every single major bull and bear market for God knows how long. I went back, and just like other people did, I said, okay, it behooves me to do it as well. So I've done it. And then I've studied every major bubble and economic cycle going back to the 3rd century. And all that's available on Fine Leading Stocks under the historical precedent tab. But basically, you notice that tops and bottoms take time. The one thing they have in time, each one may look different, but more or less, when a market tops out, you'll know because it takes time. It doesn't just happen overnight, bearing some unforeseen major shock. Fukushima, the earthquake and nuclear, meltdown back in Japan a few years ago, the market just sold off hard. And that wasn't even a big top. It was just a steep decline, but that was an external shock. You can't predict those. But tops, definitive tops, take time. Definitive bottoms take time. They don't just happen overnight. So the S&P 500 hit an all-time high in the middle of January. 2 weeks later, the first week of February, everyone's asking if the market topped out. And you were 6% below your all-time high. So again, that just helps understand what's really happening. Technical signals. So there's a few technical signals. We discussed most of these in the first webinar. The ones that we're going to really focus on tonight are going to be the last two, the moving averages and the pullback off the high. But before we do that, let's just revisit support and resistance. Here's support. If you look at the horizontal black line, more or less this is a zone. It's not an exact price. You notice that it undercut briefly here, and then a little bit right here. Here it held it perfectly. But more or less in this chart, this market, the support is right there. And every time it gets down to this area, it finds support. Buyers step up and defend it. And that's the concept that you want to keep in mind. The big institutions defend support. And conversely, resistance is the exact opposite. Big institutions, they're defending resistance, if you will. They sell into it because they want to buy more when the market pulls back towards support. One of the biggest areas that we discussed last time was think like an institution. The unspoken word here is a successful institution. And what these people do, I know them because a lot of them are our clients with AnalyzeWallStreet.com. That's an institutional service that we offer. They are stepping up and they're buying near support. What happens is they don't just buy breakouts. So that I noticed about 7-8 years ago, and I realized I'm like, okay, if these guys that are very, very successful aren't just buying breakouts, and most breakouts fail and get knocked around, it behooves me to go out there and find a better way. So that whole A and DAMP, the advanced entry points that we're discussing tonight, the concept that I want to drive home is think like a successful institution. You want to buy near support, not just the breakout above resistance. It'll help you a lot, tremendously. Think in probabilities. No one knows what's going to happen tomorrow. I don't know what I'm eating for dinner tonight, let alone where the market's going to be in a year. So if you're going out there, anyone tells you that they do know what's going to happen in the market is just either straight lying to you or is delusional. And if they did, they'd own an island in the Caribbean, or a few islands, if not half the continent. But the reality is no one knows. What we do know is what's happening right now. So the best way to explain this is if I walk in and I meet you and I have tattoos all over my face, I'm wearing a big leather jacket, I come in there with a mohawk and shaved head, blah, 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 you're probably going to think I'm a punk or a biker or something along the Hell's Angels, something along those lines. Conversely, if I come in there well-mannered, well-dressed, clean-cut, shaven, well-spoken, suited up, you're probably going to think, okay, this guy's professional. Not every time that the biker's going to walk in there, the guy who looks like a biker is going to be a biker or a criminal or a shady character. Not every time the clean-cut guy is going to be a stand-up individual, but more often than not the guy that fits that probability is going to be that the shady character is going to look like a shady character and will be a shady character, and then the professional hopefully will look like a professional, but do your due diligence, of course. And then the idea is just to you can tell when they walk in what's their behavior. Now, if they walk in and they're behaving erratically, you know the guy, stay away from the guy, he's bad news. Same thing with the stock. You can tell what's happening right now. So when you shift your focus from, oh no, I got stopped out of it yesterday, what do I do today? We'll get to that in a second with the exit points. Think like the institution, just interpret what you see happening right now within the broader context of the move. You know, which state are you in? Are you in an upstate, a sideways state, or a downward state? And then always, always, always respect risk. And that's the other part of this advanced buy entry points and exit points is you want to lower your risk. So as we mentioned before, institutions defend, support, and resistance. The question is, you know, what are you doing? Most of the time, you're buying when it breaks out above resistance, which is up here. Meanwhile, the institution is buying it down here. And then you get stopped out, you're frustrated, it pulls in, it negates the breakout, but it's acting perfectly fine because it finds support above here, and then it takes off again. You're upset because you're stopped out. Meanwhile, the guy who gets in nice and early, even around here or down here, is loving life and has big profits. And I hope that helps. The other point that I want to drive home too, which has helped me a lot, not just in markets but in life as well, is ask yourself, be smart. You know, whenever you make a decision, most of the time people make emotional decisions. Mike knows a little bit earlier today, I did something dumb. I went out, I got a Haagen-Dazs shake, and I ate half of it. I haven't had ice cream in 6 months, and I had a craving. And then I went to the gym for about 2 hours, just did cardio. It wasn't smart. I knew what I was doing, but the decision wasn't a smart decision. And before I did it, I asked myself, is this smart? And I knew that it wasn't a smart decision. But before I asked myself, am I going to buy the stock or am I going to sell the stock, I always ask myself, is it smart? And that guides my decisions. Now, I'm not always going to make a smart decision, but it'll help. You'll catch yourself infinite number of times doing things that otherwise aren't smart. You can replace that with any other word you want. But when you buy stocks, make sure you're being smart. When you sell them, make sure you're being smart based on the information that's being discussed tonight. The advanced entry points versus classic entry points we'll get to in a second. The idea here is advanced entry points. Where am I going to get out if I'm wrong? That frames your thought process. Don't worry about, am I going to get in, how much money can I make, blah, blah, blah. There's a great quote by one of the market wizards that the winners are going to take care of themselves, just take care of your losers. And again, if you respect risk, that's a D and damp, defense first, you'll do much, much better over the long term. The classic entry point, the problem I have with buying the breakout or buying 10 cents above the breakout and then 5% or 10% or whatever word you want to use, the max buying, all this type of stuff, is that it's too far from support. And then you get in and your exit's just too far away. A normal pullback is going to stop you out. You lose money. The stock's perfectly fine. It takes off. And it happened to me so many times until I just had to find a better way. So again, the bottom line is just be smart with these advanced buy points and exit points. And the whole goal is to reduce your risk. Here's a chart we used last time to illustrate the point. The classic entry, here's a chart of Apple from a few months ago. Fine leading stocks bought it right here, right off support. The classic breakout was right up here. And that illustrates exactly what we're talking about. Here's resistance, here, more or less a zone right there, and then right again there. You had the breakout right there. Okay, you could have bought that breakout if you were back here. If you did, great. If you didn't, then that's fine. It really went nowhere for a few months here. But every time it pulled back, it found support right at those old chart highs. So that white line right there is support. The institutions obviously are stepping up and defending it. Could it be Carl Icahn? Sure. He publicly said he bought hundreds of millions of dollars of their stock right as it pulled back. And then it takes off. New money comes in, shoots up to here. For a trade, as an exit point, you're now profitable. You got in here, it's up here. You know there's that pocket that we spoke about. Okay, you know it's going to pull back. Lo and behold, it pulls back. Shocker, I know. And then it negates this breakout. So if you just extend that dotted line, you're frustrated if you would have bought that breakout. Meanwhile, you get in here, you still have a cushion. Now, of course, you would have been able to get out if it was a trade. You had an upward trend line, you could have gotten out. There's a million different ways. You could have moved your stop up to here. However you want it, below the 50, however you want it done it, it doesn't matter. The point is that you're profitable and you're locking in a profit. And that's the edge, that's the goal that I'm trying to drive home here, because that's what learned for me, and then it clicked and everything just made sense. And more importantly, the results followed. Here's a real-time chart of Tesla. They just reported after hours. Let me take a look. And the stock's up 23 bucks. Or 12%. So this is a huge winner for fine leading stocks. This was bought just a few weeks ago, and if you notice, we bought it right there, 158.10, and we bought it with that advanced entry point, the downward sloping white, the white trend line. Here's a real-time case study. Many people ask us, hey, how does this work in real time? Sure. The last webinar we gave was a month ago. Before we actually bought this. It was before the correction really kicked into gear. But what happened during that S&P, the 6% pullback, you had Tesla form this. They reported earnings way back here. You gap down. You had this big cup and handle form, and this was based off of the software, which shows you the different patterns, which have a strong respect for, and I love to death. These guys do a great job. But the classic cup and handle would have gotten you in up here, or you would have bought the breakout of all time, the new all-time high right up here. Regardless, the early entry point, we're in right there. Now, as of today's close, we had a, excuse me for a second here. Let's take this over here. We had a double-digit profit. Let's see where Tesla closed, 193. So let's move Tesla up to here. We're up 22%. Now in after hours, since that buy, we're up 40%. So it says, we're up 30% in a few weeks. Now it's even more because we're all the way up here now with this gap up, depending if it stays until tomorrow. But they just reported earnings. They smashed numbers. Stock, there's no question the card, the innovation, the new product that's in demand. A buddy of mine just got one. We were just talking to Mike before. We both want to get one and probably will. And it's the future. There's no question. At some point in time, you're going to go to electric. There's no point going to pump gas anymore, getting dirty, getting out in the cold or the rain or whatever. It's the future. There's no question. The stock, how do you trade it? What we want to do is we want to make money. If I would have told you right here to get into Tesla, you would have lost. The goal of what we do is to help you get in time and time again with all these ideas right here, as soon and as early as possible. So it gives you that edge, and you can see the cushion. So you had going into the close today, you had a 25% profit. The close was right around here today. So you had a 25% profit from the early entry point. Up here, you would have been sitting on a few points and sweating it into the close, because if it gapped down, you'd be toast. And the early entry points gives you a nice big cushion. And thankfully, it gapped up, and we have even a bigger cushion. That's a good example of the real time. So as far as exits, Marty Schwartz, author of Pitbull, gives you a great line, which I love. And it's another great book, definitely recommended. Your winners are always ahead of you. He doesn't say always, I say always. He just says your winners are ahead of you. It is a great way of thinking. Again, looking forward, not backwards. So there's two types of exits. I don't care who you are, what you're doing, what you're buying. You're buying futures, you're buying stocks, you're buying options. It doesn't matter. You're either getting out for a profit or you're getting out for a loss. That's it. There's no other possible scenario. If you get out for a profit, as far as the exit, you want to protect your profit. Or if you're getting out for a loss, you want to protect your capital. So the first thing we do whenever we buy, and this helps with the advanced exit and entries, with the exits, before we enter anything, we know exactly how much we're going to risk. That's the D and damp. Okay, typically we risk 1% of our portfolio. So instead of saying I'm going to get in here and if it drops 10% or 7% or 8% or any other number you want, I'm going to get out, that doesn't really tell me how much of my portfolio to risk. The important thing here to understand from an exit standpoint is to define your risk. For us, we found in the big institutions out there, and there's a ton of research on it, 1% is a magic number. So if you're out there and you say, okay, I'm going to risk 1% of my portfolio. I have $100,000, 1% is $1,000 from my entry to my exit. Now, if that's 7% or 8% or 10% or 5% below your entry point, that's fine. But that's secondary. The primary thing you need to focus on is your portfolio, because that's your capital. And if you don't protect it, no one else will. And remember, the competition that you're going against are the largest, successful, most resourceful people in the world. And they only have one goal. They want to take your money. And make no mistake about it, that is their only goal. Every day they live and die. It's a performance business, just like Jeter or A-Rod or any of these other guys, or the Olympians. Today, the Olympics going on. They get paid if they perform well. If they don't perform well, see you later. It's no hard feelings. It's not personal. And that's just the way the nature of this business is. It's a performance-based business. But if you do perform well, you will get paid very, very well. So their goal is to take your money. So how do you outsmart them, or how do you be smart, just to continue with the theme? It's okay, let's take a look here and look at the loss from my capital standpoint, from my portfolio. I don't want to lose more than 1%. And if I'm right, the winners are going to take care of themselves. Now, a lot of psychological damage occurs when you get stopped out. A few days ago, got an email, a client got stopped out. He wanted to get back in. It was a leading stock, acted well. And he's like, Adam, I just got stopped out. I took a loss. Stock's fine. Okay, great. It doesn't matter. The market doesn't care who you are. The market doesn't know you. What matters is it's in your head. And if you're able to, your only goal with trading and investing in general is to take advantage of opportunities. Put another way, just to make money. So if you're stopped out yesterday and you're stopped out again today, you're stopped out 2 weeks, it doesn't matter. It's right now that matters. Is there an opportunity that you can capitalize on? Now, it's very, very difficult in practice to do that, and it requires a ton of personal development and growth. But that's really the important concept that I want to drive home, that look forward. Your winners are ahead of you, not backwards. Now, we can get into that later. If you have any questions, email Mike or myself, but that's just the concept is you protect the profit or you protect your capital, and then how? Well, when you exit, if you enter right, it's going to help you exit right. And that's huge. Because, again, with the classic entry point that we spoke about up here, instead of buying up here, where's your stop going to be? If it's 10% below or 8% or 7 or 5, whatever number you want, it's going to be somewhere in here. If you get out, if you enter here, not only can you take a bigger position because your exit's right here, you know that if it breaks down below this white line of support, material damage is going to have occurred on the chart. So your entry defines your exit, and it gives you a much bigger position at a much lower risk than buying all the way up here. And if you buy up here, remember that pocket we spoke about, look at that pocket. And that happens time and time again. And the same thing up here. Imagine you're buying up here with the classic breakout, the high of the handle, plus 10 cents, blah, blah, blah. You're getting in way too far and too extended. And then look, there is a pocket between there and there. So the idea from the exit standpoint is define your risk. Enter right and define your risk. If you enter right, you're going to get better exits, plus you're going to make more money because you can take a bigger position with the same amount of risk. You're still going to risk that 1%, $1,000 on a $100,000 account, because it doesn't matter how much you're risking. What matters is there damage on the chart? And that's the second point here. Did material damage occur? You know, when you get out, you don't want to just get out based on, oh, it's 7% below my entry. But what if you get out, 7% below your entry here is somewhere down here? It's perfectly fine. The stock's nothing's wrong. 7% below your entry up here is down here. It's perfectly fine. Still above support, still above the 50, but you're stopped out and you took a loss. So 8%, 10%, whatever you want. The idea is if you enter right, you want to get out and exit. Make sure your stops, for us, it's imperative, even with fine leading stocks. Every time we put out any type of buy alert or buy signal or buy anything, we have a predetermined exit stated in advance before the market opens, and it goes out. We're going to enter here. If wrong, we're getting out here, and you risk 1%. That's it. There's no questions asked. And you leave it. You automate the process. And that also removes your emotions from the decision-making process, which is tremendously important. And we discussed that in a prior webinar with the psychological analysis, which is something that I've coined, which is similar to fundamental and technical analysis. Psychological analysis is huge. I definitely recommend watching the webinar. But that'll help improve the psychology because your psyche is very, very important. And remember, the only one stopping you from making big money in stocks is yourself. The more you learn, the better you get. It's that simple. So you want to make sure you exit with material damage. If you exit, when are you going to re-enter? So sure, you're stopped out. Did material damage occur? If you bought the breakout, most probably it didn't occur. You still have to protect your capital first and foremost. And there's nothing wrong with buying breakouts, mind you. It's just not the primary way we do business. We try to get in early, but at occasions we do buy breakouts, and that's perfectly fine when it warrants or when it needs be. But the idea is, okay, well, let's say we got out. Tesla's going to take off and go from down here, look at that breakout down there, which worked perfectly, all the way up to here. Well, if you get stopped out here or here or here or here, anywhere along the way, does the market care? Is the stock going to stop going up because you're stopped out? Of course not. It's going to keep going up. Your goal is to be aligned with what's actually happening, not what you think is happening. So the goal is to, if you get out, sure, that's fine. If I'm still in the leading stock, I want to sink my teeth into it. When am I going to get back in? Now, there's many different strategies you can use. The most simple is just to use your first initial entry if the damage hasn't occurred. So in other words, if you bought wrong, even if you bought right, technical damage occurs, and now the market's righted itself or the stock's righted itself, it's going back up again, have a predetermined alert. You can do that now for free and have as many alerts as you want with Ameritrade or E-Trade or your broker, whoever you use, and it's free. And you can set the alerts you want, and unlimited alerts. So I always ask myself, I'm like, okay, here's my entry, here's my exit. Now, if I'm wrong and I'm stopped out for a loss, which of course happens, when am I getting back in? And I know when I'm getting back in ahead of time, and then I monitor and I move that alert every week. And if I'm stopped out, sure. The next question becomes, second I'm stopped out is when am I getting back in if the stock goes back up? Because it doesn't matter. The stock's going to do what it's going to do. If I'm owning a leading stock, which is my goal, then I really want to be in it. And if I'm stopped out, that's fine. I know that I have to protect my capital first and foremost. But I also know that I want to get back in it and not miss a big, big move. Because the stock's going to do whatever it wants, regardless if I'm in or not, and I want to be in it. If you own a monster stock, which is the goal, like Tesla or like Apple or Google or Priceline or any of these other stocks that we show up time and time again in our reports, you really want to learn to sit. Livermore had a great line, another book I recommend. As you can tell, I'm a big fan of reading these books, but more importantly, applying what works for you, because what works for you might not work for someone else. But Jesse Livermore had two books. One he's noted for, From Reminiscence of a Stock Operator. Another book he wrote, which I strongly recommend also, and a lot of the teachings today are based off of it, is How to Trade Stocks. And he said the big money's made when you learn to sit. And there's nothing further from the truth. It's the best thing you can possibly do. You sit in big stocks. And that's very difficult. Google was another stock that we had bought in the service back in October. We still own it today, and we're up 22, 23% and somewhere in that area. And we held it through earnings. The stock had a pullback. And I pull up a chart of Google for you so we can take a look at it in real time. But basically what happened was, here's an annotated chart, daily chart. You can go back and see. We bought the stock. That big breakaway gap right there was earnings. So let's just zoom in a little bit. We bought that gap, and it was a breakaway gap, but it was a material change, and we knew something was up. Bought right around 980. Stock never looked back. You pulled in, a little bit of a flag emerged. Either way, the stock we had set had a big, huge rally. We were up double digits, and then we knew that the pocket's coming. Lo and behold, it pulls right back in, and then blasts off again. We still own the stock. We bought it right there. So, keeping the stop further down low enough. Now, of course, we moved it up to break even, and thankfully we had a cushion, and this was the one that worked out. Not all work out, but the ones that do work out and turn into these big monster moves, the key is to give it room and learn how to sit. Because when you learn how to sit, you're going to do very, very well and make a lot of money over the long term. And then again, you look forward, not backwards. The reality of the situation is what you did yesterday just doesn't matter. What matters is what you're doing right now. The stock's going to do whatever it wants to do irrespective. So let's take a look at this chart that illustrates the point. This is a chart. I took off the name of it just to ask you guys if anyone knows what the chart is. Had almost a 3,000% return from the '08 low of $45 all the way to where it was just a few days ago at $13.08. Stock's Priceline. Monster stock. And as you can see, the 50-day moving average, which is the white lines, this is a weekly, so it's a 10-week moving average, wasn't respected the whole way up. So it's going to break the 50. It's inevitable. But during these big uptrends, look how it holds it almost perfectly. Again, here, look at that. It's perfect. That's why it's important to use the 50, but it's not a be-all, end-all. But the point of this exercise, this chart, is just, it doesn't matter when you get out or when you get in. It's going to go. And are you going to own it and make a 2,800% return? Most likely not, but there's nothing wrong with that. You can buy it many, many times during this ascent as long as you just have the right frame of mind. Now, we are running short on time, so we're probably going to go a little bit over. I'll do my best to go through this, and it will be recorded. The part here that I want to sink your teeth in is, we spoke about this briefly before, is trend lines. It's a great way of using, they exist everywhere, your job is to find them. It's a great way to identify early entry points. There's two types of trend lines we look for. In an uptrend, the first state of the market, the up state, you look for pullbacks off highs. I did not invent this term, it's well known. And in downtrends, state 3, I look for pullback off lows. And look to buy weakness, as previously mentioned. Here's a chart of Yahoo.com, and Yahoo had a great move, and as you can see, these little downward trend lines in these bases, base on base on base, perfect action all the way up. And if you get in right there, as you break out of these downward trend lines, you can do very, very well. It's a pullback off the high. Here's a chart of Bank of America. For full disclosure, I've owned this stock for, I think, about a year and a half now, since $10, and I've done very well. Showed you in the prior webinar, pulled back into support, and if you notice, it briefly broke it, but more or less it held. And yeah, you would have been stopped out, sure, if you would have been tight. I gave it a lot of room because I knew that this was a big winner, and I owned it at 10. So the classic entry points are these white circles all the way up, and the breakouts, which are the Sarhan entry points from the early entry points of the white circle. The classic ones are the yellow ones, the yellow squares. And as you can notice, there's a big difference between each one of these early entry points and the classic breakout. And you can see the edge, and that's the point of this chart here. They're all pulled back off the highs. If you notice when the trend line starts, you can draw the trend lines many different ways, which we'll show you, but really the theory, the concept, is what matters most. and you just find the high. You know that the pocket's there. You know the magnet, it's going to fall. You wait for it to fall. You build that trend line, and then you wait for it to break out again. This way, you're not catching a falling knife. Here's the chart of Priceline annotated, and this is a daily chart going back 1 year for the past year. As you can see, the 50-day moving average since right around here has been respected all the way up to here. So that was a really nice move. And if you buy those pullbacks, you can do very well into the 50. But you can also do well if you get in here at the different bases, just like Yahoo. You had the downward trend line, it's your early entry points. Oh, so here's a question mark. What do you think is going to happen up here? This is a chart of Priceline from 2 days ago. So you think it's going to keep going straight up? Sure, it could. Most likely, it's going to pull in. It's going to do exactly what it did up here or any other prior chart high. You're going to get another downward trend line, and sure, you're going to be able to get in again. So would you buy it up here? You know, I think you can tell the answer. Same with the biotechs. Wait for that pullback, and then buy the pullback and buy the early entry point. Look at where support is, and look where the 50 is, and look at the prior chart highs. So be patient up here. Don't chase. The exact opposite in gold. You know, if you look at, here's a bear market. Gold was down 30% in 2013. The S&P was up 30% more or less. And here these pull back off the lows. So the exact opposite of the pullback off the high. The last section we're going to discuss this evening is moving averages. There's two types of strategies with moving averages that are popular. There's more, but the two popular ones are when you have the price of the stock or the market cross above a moving average, or you have one moving average cross above another moving average, a fast and slow, short and long, however you want to word it. There are an infinite number of moving averages. And all the moving averages, let's say a 50-day moving average, you take the past 50 days, you divide it by the 50 days, and you get a smooth line. And that just smooths out the, more or less, it's a simple moving average. And the early entry point, the advanced entry points for the scope for this conversation, there's two strategies. The price moving over the crossover. So the price itself, here's a chart of data, ticker symbol data, it's another leading stock. But you just go long when you break above the moving average, and you go short when you break below the moving average. It could be the 50, it could be the 21-day, it could be the 10-day, the 9-day, the 18-day, the 200-day, it doesn't matter. But the important thing to know is that if you're doing long only, the strategy, the early entry point, it doesn't matter what happens with support and resistance. The only thing that matters with this logic is that you're getting in when it closes or crosses above a moving average, and then you get out when it closes or crosses below a moving average, and then you get back in when it goes back above. So the idea is it's going to force your hand, and it's an objective way of saying, okay, am I getting out or am I getting in? It's that simple. You can backtest all of these strategies. I highly recommend you do. Just for a little hint here, save you some time. If you backtest the 50-day moving average strategy, which I'll get to in a second, in the S&P, only going long and short, just long short. If it closes above the 50, you're long. Closes below it, you're short. Over the last 20 years since the SPY started trading, which is the ETF for the S&P 500, it underperforms the S&P. So it's not the best strategy buying off the 50-day moving average. Other strategies work great. Now, using the 50-day moving average and other moving averages as secondary parts of your process or as early entry points, it's extremely helpful. So if you see, for example, you're going along here, you had a nice move, it held the 50 all the way, that pocket that we spoke about here and we spoke about here, it holds. So there's no reason for you to panic and sell. You're expecting that pullback up here. Now, if you're short-term in nature, you can sell up here and buy back here, sure. But for the ones that want to sit for that big move, learn to sit by just giving it some room, expect the pullback. But if you want to get more robotic about it, which a lot of people do, you can create backtest, and it'll tell you how it would have done objectively, no question. There's no emotion. It's just get in, get out, get in, get out. So here's a long only. You'll get long, you exit the long. This one was long short. So here, this one too, the S&P 500 crossing above or below its 10-week moving average. I should say this is a different strategy now. So the moving average crossover strategy. You had the price moving average crossover when you had the price of the stock or the market go above or below moving average. The second strategy is when you have one moving average cross another moving average. It has nothing to do with the price. So, for example, the 10-day moving average here is the yellow line, and the 50-day moving average is the white line. So every time one of these circles, the 10-day moving average crosses above or below a 50-day moving average, or any other set of moving averages you want. And the same logic applies. You go long, you go short, or you exit your long. Or you can go short only and exit your short, however you want to word it. But basically, the logic implies that, again, it's objective, and you can backtest these strategies in an infinite number of ways, and there's an infinite number of moving averages. But the purpose of the illustration tonight is just to illustrate other ways of getting in these advanced entry signals. And then here's the POL that we spoke about with for gold. And these are the white dotted lines. So it's important to use trend lines as a filter. It's another strategy, and then we'll wrap up pretty soon and go into Q&A. But basically, if you want to get in and get out, you can use the trend lines, as we mentioned before, the crossover strategy, or you can use them as filters. So, for example, I'm only going to take long signals, buy support or buy breakouts or buy, only take long signals when one moving average is above a second. So, for example, if the 50-day moving average is above the 200, I'm only going to take long signals. Or I'm going to ignore all long signals if the 50 is below the 200, or what have you. That's also a very helpful way of just being objective and then defining the state. Is it uptrend, is it downtrend, or is it sideways? In general, to summarize here, the concept that you want to drive home is advanced entry points and exits. You want to enter as close to support as possible. Buy before the crowd. Buy before the breakout, the classic breakout. You want to reduce your risk as another benefit. It's easier to exit because if you get in at support and it breaks support, you're going to have material technical damage, and it's not just a normal pullback within being healthy. And then the key concept that I've really developed over the last 15 years or so has been buy weakness. Buy leaders on weakness. Don't just buy them on strength. You'll do much, much better over the long term.
Thank you all for watching, and we hope that you enjoyed this video. If you were watching us on YouTube, please take a moment and click the like button here at the bottom, and also take a moment to subscribe to us if you are on YouTube. If you'd like to try out Adam Sarhan's Find Leading Stock service and see all of these advanced entry and exit points in action, visit findleadingstocks.com and save 10% off of any membership level by using discount code CYT when you check out. Again, visit findleadingstocks.com and use discount code CYT to claim your 10% discount. Thank you and have a great day.